Welcome to Talk Tickers. Today we're doing a deep dive into one of the biggest shifts we've seen in modern capital markets, the direct listing, or DL.
That's right.
For so long, the traditional IPO was, the only game in town for a company to go public. But that whole model is being seriously challenged now.
It really is. A direct listing is this increasingly popular but also pretty controversial alternative for these huge high-profile companies to hit the public markets.
And today we're going to explore the whole thing, the mechanics, the massive cost savings, and probably most importantly, the unique risks that you as an investor really need to understand.
Especially if you're thinking of jumping in on day one.
Exactly. Our mission is to unpack why these big unicorn companies are ditching the old Wall Street playbook and, what happens when they do. So let's start with the basics. What exactly is a direct listing?
So at its core, a direct listing is simply the process of listing a company's existing stock for trading on an exchange, like the NYSE or NASDAQ. The key is they do it without an underwritten offering.
Okay, that lack of underwriting. Let's really dig into that because that feels like the central difference here. In an IPO, the bankers buy the shares first, then they sell them on.
Right.
How does that work in a deal? Or I guess, how does it not work?
Well, there's no intermediary. There's no one buying the shares in bulk. The company still files a registration Form S-1 with the SEC, but this is mostly to allow a secondary offering of existing shares.
Secondary offering meaning?
Meaning they aren't selling new stock for the company's own bank account. They're just registering the stock that's already owned by insiders, by employees, by early investors, so that those people can sell.
So why is that S-1 filing so important then if no new money is being raised for the company?
It's critical because those shares have to be legally registered to trade on a public market. It legitimizes them. And that mechanism gives immediate, transparent liquidity to those existing shareholders.
And they can sell at whatever the market price is, not some price set by a banker in a back room.
Precisely. It's determined by pure supply and demand from the first minute of trading.
So historically, that was the trade-off. Insiders get liquidity, but the company gets no new cash. You had to be a Spotify or a Palantir, already rich with cash, for this to even make sense.
Exactly. But, and this is a vital piece of context, that definition is evolving fast. The NYSE, for instance, has proposed rule changes to allow a primary offering alongside the secondary listing.
So a company could list directly and sell brand new shares to raise money, all without underwriters. That sounds like having your cake and eating it too.
It kind of does. Now, those proposals have some very strict requirements, which we can get into. But for now, the foundation to understand is that the classic DL is about liquidity, not capital.
Okay, so let's talk history then. If the IPO has worked for generations, why are all these huge successful firms suddenly abandoning it? It has to come down to cost.
It does. And the biggest cost is often the one that's not even on the invoice. Let's start with the indirect costs, because this is where it gets really interesting.
You're talking about IPO underpricing?
I am. It's a massive, well-documented problem.
Yeah.
Just systematic underpricing.
We're talking billions of dollars left on the table.
Billions. The data shows that historically, IPOs have been underpriced by an average of 16.8%. Over 50 years. Just think about that. A stock lists at $20 and jumps to $23 in an hour.
The company just lost $3 a share.
For no reason. The bankers just set the price too low.
But why would they do that? Why would underwriters consistently lowball the price? It seems like it hurts their own client.
Well, it's driven by something called informational asymmetry. Or, to put it more simply, it's about managing their own risk and rewarding their best institutional clients.
Okay.
By lowering the price, they entice big funds to buy in, guaranteeing the whole issue sells out. It ensures the deal is a success, and those big buyers get a nice first-day pop-in price. It's like a thank you gift for participating.
A kind of subsidy, really, to make sure the deal gets done and remove the risk for the underwriter.
It's a mechanism to avoid what's called the winner's curse. By underpricing, they make sure even uninformed buyers make a quick profit, which keeps them coming back for the next deal. A direct listing just cuts out that whole game.
So that 16.8% is money that goes straight back to the company in a DL. What about the direct costs, the fees you can actually see?
Still huge.
Yeah.
A traditional IPO has underwriting commissions around, 7% of the offering size?
7% on $1 billion deal, that's $70 million.
Exactly. DL has just wiped that fee off the map completely. It's transformative.
And it's not just money, right?
There's
a control aspect, flexibility.
Absolutely. Traditional IPOs have that standard 180-day lockup period for insiders. Management can't sell. A DL. No lockup. Immediate liquidity. If you're an employee who's been holding stock options for 10 years, that is a life-changing difference.
But doesn't that create a perception problem? If the founders are all selling on day one, couldn't that signal a lack of confidence?
That is the tension. It absolutely adds to the uncertainty. But for the pioneers, the Spotifys and the Slacks, they were so big and well-known already, they felt they didn't need the market to validate them. They just needed a place to trade.
They traded that stability for the savings and flexibility.
They did. And the whole marketing process changed, too. The old multi-week roadshow, bankers flying around, building the book.
It's all gone.
Gone. Instead, you have an investor day.
Yeah.
It's a webcast. It's about educating everyone at once, not this exclusive process of doling out shares to preferred clients. It's much more democratic.
So, okay, the company wins on cost, control, efficiency, but there's no free lunch in finance. Let's pivot to the investor side. What's the downside for someone like me buying shares on the first day of a DL?
The primary downside is volatility. Massive volatility and uncertainty around that opening price. Without that underwriting syndicate, you have no stabilization support, no price floor.
So if there are no bankers setting the price, who does? How is that first trade decided?
It's determined entirely by the buy and sell orders that are collected by the exchange's market maker. It's a single opening auction. They might look at recent private sale prices as a reference point, but the actual supply of shares for sale,
It's a complete unknown.
a total unknown. It depends entirely on how many employees or early investors decide to hit the sell button that morning. So you can get these wild price swings.
It sounds like taking the underwriter out removes a huge safety net, but they still need some financial advice, right? They can't just do this alone.
Oh, absolutely. The rules are very clear. They have to hire financial advisors, and there's a really critical independence requirement. One advisor have to provide an independent valuation of the shares to help the market maker set that initial reference price.
Then why is independence so important there?
It's to stop conflicts of interest. The rule says that any firm that's provided investment banking services to the company in the last year cannot be the valuation agent. It's to stop an underwriter from just, putting on a different hat and doing the same old thing.
Okay, that makes sense. Let's move from operational risk to what might be the scariest part for a retail investor, the legal liability. And this all comes down to a Supreme Court case, Slack Technologies v. Pirani.
This case is pivotal. It really raises huge questions about shareholder protection. It's all about Section 11 of the Securities Act.
Which protects investors from lies in the registration statement, the S-1.
Correct. In a normal IPO, if the S-1 has a material misstatement and you bought shares, you can sue. Simple.
Mm-hmm.
But the Supreme Court's decision with Slack changed that for direct listings.
How so?
The court said that to bring a claim, you have to prove your shares are traceable to the specific registered offering. And it's a massive headache in a DL.
Explain that tracing problem. You said in a DL you have registered shares and unregistered shares hitting the market at the same time.
Right. Imagine you have two buckets of stock on day one. Bucket A is the newly registered shares. Bucket B is all the pre-existing unregistered shares that insiders can now sell when you buy 100 shares on the open market.
They just get mixed together. There's no label saying bucket A or bucket B.
Exactly. The shares are fungible. So proving that the specific shares you bought came from the registered offering in bucket A becomes almost impossible.
So if the stock tanks because the company lied in its S1, my ability to get my money back is limited because I can't prove I bought one of the bad registered shares.
That's the heart of the issue. It creates a huge barrier for investors that just doesn't exist in a traditional IPO.
Wow. Okay. Beyond legal risks, there's also governance. A lot of these DL companies use dual-class share structures.
Yes. And this is a major factor. You look at Coinbase, you look at Spotify, they have these structures where the founders and insiders have special shares with way more voting power.
So they might own, say, 10% of the company economically, but have 60% of the voting control.
Something like that, yes. It means you, as an outside investor, have very little say in how the company is run. It limits your influence on corporate governance, and it's generally not very popular with the public markets.
So while a DL avoids dilution, the trade-off is this really concentrated power structure.
It is. The insiders get to keep control and maybe prioritize their long-term vision over say, the short-term profits that shareholders might be demanding.
And really quick, these aren't for small companies. What are the barriers to entry?
They are definitely for the unicorns. To qualify for a DL on the NYSE or NASDAQ, you need an independent valuation showing at least $250 million in the market value of publicly held shares.
$250 million. So that's a high bar to ensure only mature, substantial companies are even attempting this.
It is. And the regulators want to be sure there's enough of a public float to avoid a chaotic, thinly traded market on day one.
So with all this, especially the new proposals for primary direct listings, are DLs just becoming a new type of IPO?
That's the million-dollar question, isn't it? Or maybe the billion-dollar question. If the new rules let companies raise fresh capital, say $100 million or more in that opening auction, it bridges the gap in a huge way.
But doesn't that just put the market maker in the position of an underwriter without the same name?
It definitely transfers a lot of that risk and complexity to the market maker, which is why the rules are so debated. But if they go through, and NASDAQ is expected to follow, you could get the best of both worlds. The cost savings of a DL with the capital raising of an IPO.
Before we wrap up, we always ask you for the one thing to keep in mind. The one question.
When you are looking at a direct listing, ask yourself, what is the level of voting power that the founders and executives are keeping?
And that matters because that dual class structure tells you everything about the power dynamic. It tells you if you're buying a piece of a company or just a ticket to watch someone else's permanent vision play out.
This deep dive really confirms that direct listings are a real, evolving alternative to IPOs. They have clear advantages cost, no underpricing, immediate liquidity.
But investors have to accept the trade-offs. Higher volatility is almost a given, and that legal liability issue after the Slack decision is a serious risk to consider.
Right. For a sophisticated investor, it's a great way to get access to amazing companies.
Right.
For someone less informed, it can add layers of risk they might not be ready for.
At the end of the day, it seems like while DLs offer this incredible new flexibility, the traditional IPO is still the only real option for a company that absolutely needs a guaranteed check from the public markets when they list.
Exactly. The underwriter's biggest promise is that the money will be in the bank. And for many companies, that guarantee is still worth paying for.
A truly fascinating evolution in how companies are built and funded. Thanks for joining us on Talk Tickers.